talk about a rough week here on Wall Street. A rough week indeed, just for the U.S. markets all around. And if you're wondering just how rough, well, it's been the worst week since 2020 when the coronavirus ravaged the globe. And if you're wondering what led to a series of massive drops at the end of this week, the answer, geopolitics, of course, in the form of U.S. tariffs, U.S. duties that were announced by President Donald Trump. Now, in further detail, countries seeking to sell goods to the United States will face taxes as high as 54% based on how the White House is calculating duties on U.S. exports, as well as non-monetary trade barriers in response to countries doing such things as manipulating their currencies or serving as, in quotes, pollution havens. That led the way for a large market sell-off, lifting fears of a global trade war and renewed recession fears, and President Donald Trump sweeping tariffs, triggering swift retaliation from China as that nation's Commerce Ministry announced on Friday that it will impose a 34% levy, a tariff, on U.S. products. This, therefore, matching the tariff on Chinese goods coming into the United States unveiled by President Donald Trump on Wednesday. A wild set of circumstances and events across the board that paved the way for the Dow Jones to trade more than 1,400 points lower this Friday, or 3.5% in the red, following a 1,679.39 point decline on Thursday. Meanwhile, the broader S&P 500 sliding 4% after the benchmark shed 4.84% on Thursday, now off more than 15% from its recent high. And the Nasdaq, home to many tech companies that sell to China and manufacture there as well, dropping 4%. If it closes at this level, the measure will be 21% lower than its December record close, which is a bear market in Wall Street terms. And now a new week awaits. It will be the first full trading week of April 2025 in the world, and investors, everyone wants to know if there will be more losses or if a rebound is possibly in sight. There's a lot of data to take in that could shape the markets, so let's jump right into it and find out what will likely move the markets in the week ahead. Now, Monday kicks off on the quiet side with European February retail sales on the docket, expectations calling for a read of 0.5%. That will then be followed by U.S. 3-month and 6-month bill auctions. Then on Tuesday, the silence remains as focus will be on New Zealand and the RBNZ interest rate decision, expected to drop to 3.5% from 3.75%. Wednesday sees action out of the U.S. courtesy of the FOMC minutes and February wholesale inventories, which are expected to remain at 0.3%. And Thursday, we see a pickup in action. First, Chinese consumer prices expected at 0% month over month for March, and Chinese producer prices, those are expected at negative 2.3% for the same period. While in the U.S., not only do we have weekly jobless claims, but also U.S. consumer prices for the month of March. Consumer prices expected 0.1% month over month, 2.6% year over year. And then on Friday, there's another one on the docket, another busy session that is. First, in Germany, we have the release of harmonized consumer prices for the month of March, a read that's expected at 2.3% year over year, while in the UK, February GDP is due out, a report that's calling for a read of 0.1%. And as the Eurogroup meeting convenes here in the United States, we have producer prices and consumer sentiment. When excluding food and energy, March U.S. producer prices expected 0.3% month over month, 3.6% year over year, while April preliminary Michigan consumer sentiment penciled in 54.5. And yes, amid retaliatory tariffs and talks of possible tariff negotiations, everyone should be keeping an eye on geopolitics, as they have obviously been the largest market movers of the past few days and likely to continue to be the big market movers in the days ahead. Follow those tariff updates, and until next week, reporting live from the New York Stock Exchange, I'm James Sweeney for ICM.